There are 680 life and annuity players in the United States. 120 of them are PE backed. All of them are competing on market share. So nearly all of them have rushed towards structured finance and private credit. They've rushed towards things that are private letter rated, meaning they are rated by Egan-Jones and Kroll. They are not rated by Fitch, Moody's, S&P. Fitch, Moody's, and S&P relies on Egan and Kroll in order to tell us what is investment grade. What we will see in this video is the journalism that Bloomberg did. Amazing journalism, some of the best I've seen in a few months. Scott Carpenter, David Sciglio, Esteban Duarte. Great job. We'll go through a piece that they've had, how these guys are manipulating the NAIC thresholds, meaning what governs your leverage from, in some cases, in a lot of cases, 30%. And what 30% means towards your risk-based capital, that means that you need to reserve $30 for every $100, meaning you can be 3 times levered, which most stock people would say is pretty high. Insurance says is extremely low. They can move that rating to even AA, where they can be levered up 100 times. People want to say, oh, can't be 2008. Can't be 2008. People aren't taking risks like that anymore. Lehman was levered 30 times. The average insurer, when you adjust for what is real capital and what is not, is levered 30 times. The average. There's 90 times. There's functionally insolvent if they don't get a permitted practice exemption. Lehman's RBC ratio would be 14,000% because it was all AAA rated paper. So that's what you need to understand. How crucial are the ratings and how are the ratings being manipulated? Let's ask Bloomberg. Why don't we just ask Bloomberg? Bloomberg, take it away. In a blast to sophisticated investors, the bank sketched a product that initially looked familiar. A bundle of stakes in private credit funds tend to be repackaged into a bond. Yet potential buyers needed only a few moments to flip through the presentation and realize it was no routine deal. The instrument, with features outside the scope of most credit ratings, would be stamped with a target grade of A2 from Moody's, analogous to the level of risk awarded to multi-billion-dollar companies such as Nike and Home Depot. But what kind of financial alchemy could turn perpetual funding for private credit, an asset class steering global anxieties, into something that looked rock solid? What a line. What a question. Tell us, Bloomberg. The answer, a rare kind of insurance provided by Nationwide Mutual Insurance Company, known to American buyers of cars and houses for its earworm jingle. Nationwide is on your side. So we are getting into a player that's actually in property and casualty that is guaranteeing private credit funds in order to get a yield for themselves and allowing these life and annuity insurance players a new wrinkle in order to be able to lever up more. Let's skip in. The proposal was described by people with direct knowledge of it, who asked not to be identified because the information was confidential. The deal remains in development, 2 of the people said. Boy, do I hope this blows up. Boy, do I hope this coverage blows up this deal. It talks about a wrinkle. These are perpetual evergreen funds. How are you supposed to rate that, especially when you have liabilities that they think are permanent or not permanent, because you can surrender, because policyholders can surrender. Nationwide says they're active. Let's look at what happens. Direct investment, meaning leveraged loans, meaning a private equity company buys a company at functionally 2x leverage and mortgages it and only puts 50% of the cash upwards. That is reserved at 30%, meaning, again, you can lever it up 3 times. Then you have a structured vehicle. The investment is routed through a vehicle with 3 tranches of varying degrees of risk and return. Losses are absorbed first by the equity layer, against which the regulators require a higher 40% capital charge. The other 2 are structured as debt and assigned a credit rating. The equity of this fund is oftentimes held by BDCs. It is the first loss. Cliffwater is 1/3 CLO equity. All of the wealth advisors I've been talking to that won't listen to me about Cliffwater. That's what you own. That's what your clients own. That is your career risk if it goes under. And in fact, we are seeing that CLO equity is typically is under stress and has experienced in aggregate 20% losses this year. the worst since I believe 2008, 2009. Don't worry about that. Don't worry about that. So what is happening here is not only that they're packaging it in CLOs and the insurance companies are able to grab the triple B slice. The triple B slice is allowed to be reserved at 1.5%, meaning $1.50 out of 100. They're taking it even further. They're doing a structured vehicle with an insurance wrapper. So Nationwide is guaranteeing a significant portion of losses in order that it gets an A rate, Nationwide's rating. If the insurer's rating is downgraded, then every tranche it wrapped will be simultaneously downgraded, leading to potential correlated downgrades across an insurer's entire wrapped portfolio and forcing selling by investors. What we need to understand is that as soon as downgrades happen, you have to post more capital or you're going to go into receivership unless you get a permitted practice, which these in-bed commissioners in Iowa, particularly Vermont, these in-bed insurers that should be in jail forever. They say, unless you get a permitted practice from one of those guys, you have to post capital, okay? Insurance wrappers. Fund finance deals are proliferating and changing so quickly that it's hard to draw lines around the market and gauge its total size. 1 to $1.75 trillion, 10x from a decade ago. That rivals the ascent of Wall Street's burst of engineering around subprime mortgages, a market that swelled to over $1 trillion in the US before the 2008 financial crisis. So you have two buckets that are bigger than subprime loans. One, fund finance. Two, private credit, direct lending private credit, LBO private credit. Two, people say, oh, can't be systemic. I'm working every single weekend. I'm working Friday, Saturday, Sunday, Tuesday, Wednesday, Thursday. You want to distract me with a World Cup outside of here, okay? Just so we understand the level over the past 6 months of, well, I do my day job and I go and figure out this piece. Do you think I'm doing it for fun? No fun games. No more fun. We don't do fun. There are several main types of deals on this frontier. The most popular structure provides money manager with capital call lines, so they don't end up waiting on their bullpen of investors to put up cash to take advantage of an opportunity. Those facilities have surged, but they're still considered a largely humdrum part of Wall Street's plumbing. These are subscription lines, meaning you got pensions and you got endowments, and they can't match liquidity exactly, so they get some little help. They get a little help. Many other structures help private equity or private credit funds free up cash from aging investments. One of the hottest is a collateralized fund obligation, which involves packaging fund stakes into rated bonds, sometimes as a way to recycle investors' money into new funds. The UBS and Partners Group deals are twists on that structure. Another emerging structure, known as a rated feeder, helps insurers and other investors bet directly on a single fund. Rather than invest directly by taking an equity stake, they loan money to a vehicle that passes it to the fund. Then they get repaid as the underlying investments are returned with interest. Really just think about what a rated feeder is, and we'll get into what UBS is pitching. They don't want to reserve 30%, so they do a pass-through. It is the same exact risk, but they can do arbitrage, regulatory arbitrage. They can game the system in order to lever it up, their balance sheet, more, so that you have less capital in reserve. Capital is in reserve for a reason. When shit hits the fan, you need capital. It's the same risk, a rated feeder fund. And they actually have layers of that. They might have a preferred equity rated feeder. They might have preferred shares on that. Insurers won't do that, but these BDCs, they'll eat the CLO equity and they will eat that preferred. That one is related to another structure that spread last year, so-called NAV loans from insurers to private market funds, using their assets as collateral. One really important thing to understand when you're looking at BDCs, when you're looking at insurance companies, is what assets are pledged to whom, for what funding, for what bonds, what assets are pledged, meaning that the bank or some institution has priority over that. If shit hits the fan, those are gone. And those are usually the good stuff because the sophisticated lenders are going to take it. Do you think that these insurance companies are sophisticated? Ask yourself that question. Do you think that the BDCs have the best positioning for a potential crisis? Think about that. In each case, fund finance alchemists transform something that could have been an equity stake into a type of credit instrument, widening the field of potential buyers while creating new layers of complexity. Rod Dubitsky, who called 2008, who I've been working with closely, who is he's a genius. And, I'm trying to gather as much information as I can from what he covers and what he looks at. He's written a report on Substack that talked about exactly how you're taking an equity stake and turning it into something you can lever up 30 times. The NAIC requires that you show how these equity investments are credit-like. With a little bit of attention, they could realize that these risks are not what they say and they're more equity-like. And insurers can have to post capital in significant numbers. These products used to be very plain vanilla, but they're becoming quite sophisticated, and some have very aggressive structures. Greg Falovich, Fitch Ratings Global Head of Funds, referring to rated feeders. It's raising questions about what might happen in an economic downturn. There's not much evidence of how they will perform in weak environments, and the weaker structures may not perform as expected, he said. I've talked to Fitch as well. I've talked to Moody's as well. They say that this is private credit, these rated feeders. There's not much evidence of how they've done. I asked the analyst there and I said, well, there's pretty good evidence of what 7 times levered businesses do during an economic downturn. So why are you considering this to be completely foreign, something that you have no judgment on, and you're just deferring instead of being proactive and saying, this is how much risk there is? They're saying, well, we'll wait and see. They had no answer. They had no answer because the way that this asset class is growing is certainly unique. But the amount of data on how 7 times levered businesses that are mostly cyclical, my estimate is 80% cyclical, 30% super cyclical, how they do during a downturn or how they do in regular markets, I think the data is very sufficient to make a call. Just because you're packaging it together, you can run the analysis and figure out what is the likelihood that a triple B section of a CLO goes under, that gets impaired. It's high. It's high. It's not 30 times leverage on an insurance balance sheet. And if it goes under, it goes to the states. And if the states take it, they're going to be bankrupt if the federal government doesn't pay it out. The profit went to the private equity-backed insurers. The profit went to the equity investors in these pubcos taking dividends. The executives got paid based on performance, on cash earnings, or whatever people want to talk about. And the taxpayer takes the burden. Sound similar? Sound like we've seen that before? Sounds like it's the main game in town? Many of these structures are towards the same destination, converting private market investments into something that might appeal to insurance and annuity firms that once grazed on a much simpler fare, such as corporate bonds. What we need to understand is that there's a battle for the market share. The incentives largely, if you're an executive, you want to maintain market share. Apollo Athene, rushing into this market, set a new game. People like to say Apollo's the best. Apollo's the best. You can't worry about Apollo. I worry about Apollo. And I worry about Apollo not because I think that they can't go, not just because I think that they can go under and people don't realize that. That I think that they're arrogant, they're taking too much risk. And LTCM, they were smart guys too, they went under. But it is because they are setting the bar. They are setting the bar for every other company to take risk. And the talent at NASA Life is way lower than Athene. Okay? And they have to compete. Understand that. There are 680 of them. You can't just look at Apollo and see the risk that they're taking and say everyone else must be good. You can think that Apollo can handle the risk, and you can know that everyone else can. Indeed, insurance wraps like those included in the UBS proposal and the Partners Group deal carry substantial benefits for such buyers, making holding the debt less onerous. In the United States, a tranche of a rated equivalent of A2 requires insurers to set aside less than 1% of the capital they invest, compared with a charge that could reach 30% if they invested directly into private credit funds. It is hilarious. People talk about RBC ratio. How much capital you need? The capital you need is too low. The capital you need is too low. I will say that until the end of my days, and it won't be the end of my days because this will blow up. And we're talking in quarters, not years. To advocates, fund finance is a way for those buyers to use their decades-long investment horizons to their advantage, scooping up assets that some investors eschewed over the past year or so amid concerns that the marketability of private equity holdings and the underlying quality of private credit. The question is, private credit skeptics might eventually be proved right, hurting insurance and annuity customers years down the line. Just so people understand what happens when one of these companies go into receivership, there's 250 grand to 300 grand to 500 grand of guarantees by the state. So is this funded? Of course not. It's on the rest of the insurers are expected to hold a little bit more against the tax assets. So when shit hits the fan, one of these goes down, the rest of the insurers are strong, they lean in. When one of these big ones go down, all of them are going to be weak. There is no capital that should have been collected in taxes. They said, don't pay taxes. Here, just hold this tax asset. Have this tax asset and have a waiver, a tax waiver. As more investments move from the banking system into insurance portfolios, regulators also risk losing visibility on the underlying risk. The regulators will say that they want more visibility, but they will sign off on permitted practices that literally functionally give them less visibility. It is the most infuriating thing to see the regulator of Iowa say, oh, I wish I could see what's in Bermuda. Buddy, you allowed Apollo Athene to send affiliated paper 26 times higher than the NEIC limit. 26. You allowed that to go to Bermuda. Do not say that you wish you could see more visibility now. And the Evercore chief insurance head, who was on the Steve Eisman podcast, who failed to mention that he was a former commissioner that signed off. And whenever he's defending these practices, it is his resume. It is his track record. It is his reputation that he's also defending. He's not just an unbiased analyst. Understand this. Understand this. In the banking sector, we can conduct stress testing that we can gear in the directions of our concerns. Victoria Ivishina, a finance professor who co-heads the private market capital at Harvard Business School, said in an interview, that framework does not exist in insurance. The amount of lack of regulatory oversight. The Federal Reserve is not designed to understand this risk. They're not designed to understand the systemicism nor the risk taken on these balance sheets. That is a major danger. That is a major danger because when Treasury Secretary Bissett, who I wrote to, brings in the insurance guys to talk about it, they will say, random bullshit. They will say, oh, as a percent of our assets, this is only 10%. It's only 10%. Their capital surplus, though, as a percent of their capital surplus, it is 300%. Let's not forget. And they'll say, oh, it's all IG. Okay, who's it rated by? What is the underlying credit rated by? Is it rated by Egan-Jones? When you ask Fitch and Moody's, do they say they rely on the ratings of Egan-Jones? Sure do. Sure do. The explosion of fund finance can be traced to both supply and demand. On the supply side, legions of money managers are desperate for relief. They include private equity firms struggling to unload investments made years ago so that they can return cash to clients. No exits. And private credit funds are contending with a rising tide of loans repaid with still more debt, depriving them of cash today, meaning payment in kind. On the demand side, there are annuity firms and life insurers hungry for high-yielding assets. Why? Because they're competing. Americans prepared for retirements are plowing their savings into annuities, driving sales to a record $464 billion last year. Their life insurance policies are creeping towards fruition too. Firms, meaning boomers are getting old. Firms that sell those policies want to put available cash to work, generating strong returns. But capital rules discourage them from buying equity in higher yielding private market funds. If, however, Wall Street can convert the bets on those funds into something resembling debt and it gets stamped investment grade, the capital treatment becomes more favorable. And theoretically, both sides get what they want. If this works, it's brilliant. People get rich, nobody gets hurt. If it doesn't work, we have systemic risk. Insurance wrappers are among the emerging techniques making that possible. When proposing the wrapper on a CFO from UBS's asset management businesses, bankers were taking a page from another type of deal that has emerged over the past year or so that is already stirring up consternation among regulators and other policy words. These deals are known as SRT repacks, yet another form of fund finance. SRT deals, or significant risk transfers, have been around for decades, used by the banks to manage their balance sheets. In a typical SRT, a bank pays fees to outside investors who agree to absorb the first or junior losses on a portfolio of loans. The deals can then help banks reduce exposure to certain industries and bolster capital buffers. The repackaging element comes with SRT exposures are sliced into tranches. In some cases, a portion is backed by insurers, stamped investment grade, and then marketed onward for sale and used as collateral to borrow from a bank. Do you understand this? People want to get rid of stuff. They will sell CLO equity to a BDC or some set up CLO fund that has done great in the past 15 years and thinks that this is like free money and that they don't take any more risk and they get paid significantly more yield and the risk-based return is amazing. They eat that. The mezzanine, the insurers eat. The reason why the insurers eat the mezzanine is because for the yield, that is the lowest amount of capital that you need to reserve. Nationwide and at least a dozen other insurers providing protection so those notes can win high ratings, according to people familiar with the matter. As Bloomberg reported this month, hedge funds, Sear Capital Management, and advisors, including Cantor Fitzgerald, have been working on a deal in which part would be protected by Nationwide. That would help Sear Capital obtain about $300 million of financing from the first Abu Dhabi bank to buy SRTs. Hello, Abu Dhabi. You got a war going on? Oh, okay. You need liquidity? Hello. In at least some cases, insurance wrappers are transforming mezzanine or junior SRT tranches into something more akin to a senior instrument, according to Neil Hamilton, a partner at Mayer Brown. But the growing complexities of these structures make it all more difficult for regulators to track which firms may be piling in obligations that could come to bear in an economic downturn. I have a problem with this, that you fundamentally cannot understand the risk here. It is obvious. We've seen it before. That information is crucial for regulators to assess the systemic risk, according to Queer and Fleckenstein, a finance professor at HEC Paris Business School, where he's researching credit links between banks and non-banks, or shadow banks. That lack of information is making the financial system less resilient because it would be hard to unwind transactions and trace ultimate loss bearing. Researchers working on the banks of international settlements and the Bank of England pointed to that blind spot in a paper this year. Repackaging SRP deals fuels structural complexity and opacity. That amplifies contagion risk if one link fails. What I want people to understand here, when we were talking about 2008, we were talking about homes. They were homes going into foreclosure. There was significant amount of liquidity problems. That means that these homes were liquidated at 30% of the dollar at times. Try liquidating a direct lending stake in a shitco PE-backed insurer. I'm sorry, you say, oh, they're great businesses. No, the fuck they're not, or they would be public. Okay? Don't tell me, a public market guy, what is a good credit or not. I see the good credits. Don't tell me you're 7 times levered HVAC or you're 7 times levered dental practice or veterinarian care or software is a good credit. If it was software, it would be down 70, 80% in the public markets. The fact that it's not does not say that it's better than what's in the public markets. It says it actually could not make it in the public markets. It would actually be down 80 or 90%. When you look at the percent of total of private placements or private letter ratings, meaning Egan-Jones, meaning Kroll, that Fitch and Moody's rely on, you are looking at mutual funds like Mass Mutual taking exorbitant amounts of risk. What do they say? Percent of public. Ooh, it's all above 90% IG. What about percent of private? It's even higher in most cases. It's even higher. There's even less junk. So in order for this to all be good, you have to have absolute faith on these rating agencies. Go discover what these rating agencies are doing. Go look at your local statutory filing and you decide if we have systemic risk. Because I will remind you, and I've been saying this over and over again, this balance sheet is $10 trillion. That is 50% higher than the Federal Reserve. 50%. 50% higher than the Federal Reserve. If there needs to be a bailout, if there's $500 billion hole, if there is a panic, meaning that's $1 trillion, that's 1.5 trillion, you are going to have to set up and make those good. Private equity guys, are they going to get their money clawed back? But then there's going to be systemic risk as these balance sheets are orderly wound down, meaning that some of them are probably going to be declared systematically important, which is terrible precedent as we've seen from 2008 and the reason we have this issue from Dodd-Frank. In that case, you realize that the whole pricing is fugazi. The whole pricing, the high yield spreads in public markets, the private credit spreads, all of it. You would have to jawbone the market so hard, and you are jawboning primarily a balance sheet that's bigger than your balance sheet if you're the Federal Reserve. And Warsh has said that he's not super prone or apt towards bailouts. If you do that and it doesn't work, then you have to do 2 trillion, 5 trillion, 10 trillion. The US dollar will be on a tremendous amount of pressure while inflation will be going up. And what I would like to tell people is that the Dixie may not go down because this is a global issue. Europe has around as much of this. In fact, the Swiss bank is presenting this to us as the United States. The entire developed economy is built on leverage and it is at stake. And you have to understand, do you think that this is kosher? Do you think that this is good? And if not, what is your exit plan? What is your exit plan? Because this might not happen in the next couple months, might not happen in the next couple quarters. You may want to stay invested, but you do want to understand what the systemic risk is. You may want to do some of the work I've done, and you may want to be monitoring this because the regulators are not.